In this lesson, we will learn about strategic acquisition financing. Acquisitions often necessitate significant financing due to the substantial financial requirements involved that extend beyond the initial purchase price. To determine the appropriate financing structure, companies undertake a comprehensive assessment of the overall capital needs. 1. Purchase price. The starting point is the acquisition price, determined through valuation but ultimately finalized through negotiation. While grounded in valuation methodologies, the final price can be flexible based on market conditions, competitive pressures, and strategic considerations. 2. Transaction cost. Beyond the headline price, transaction costs can be substantial. These include investment banking fees for advisory and deal structuring, legal costs for contracts and due diligence, and accounting expenses for audits and tax structuring. While often estimated as a percentage of the purchase price, it's wise to obtain specific quotes early in the process. 3. Post-acquisition integration expenses. The integration of the acquired company into the acquirer's operations often entails further financial demands. These expenses may include restructuring costs. These costs arise from reorganizing the acquired company's structure and operations, aligning management systems with the acquiring firm's standards, severance payments, and integrating employee benefits. Capital expenditures. This is investments to upgrade or purchase new equipment, facilities, or technology, enhancing operational efficiency. This also includes modernizing infrastructure to support expanded activities and system integration. Working capital requirements. Additional funds to support the ongoing operations and growth of the merged entity, covering day-to-day expenses like inventory procurement and accounts receivable, which may increase as the business scales. 4. Determining external financing requirements. After assessing the total capital needs, the next step is to evaluate the acquirer's internal funding capacity, including cash reserves, operating cash flows, and potential proceeds from selling non-core assets. By subtracting this internal funding from the total capital needs, companies can pinpoint the required amount of external capital to complete the acquisition. This calculation is foundational in structuring the financing package. It's also crucial to consider market conditions, such as interest rates and the cost of capital, which directly affect the cost and feasibility of financing options. Strategic financing insights for different investors. While internal funding can play a role in acquisitions, different types of investors employ their own unique strategies. Understanding the motivations and options available to different types of investors is crucial in securing the right financing mix. 1. Private equity firms. Maximizing leverage for growth. Leveraging external capital. Private equity firms often leverage high levels of external capital to maximize their equity's potential. For example, employing 80% external funding allows them to acquire multiple companies with the same amount of equity, boosting return potential.